Hi, Professor Rujo Moreno with an overview of Objective 4 in Chapter 5, Benefits of Owning a Home. Certainly the interest you pay on a mortgage becomes a tax write-off. You get to reduce most of that from your income, which means you pay a lower tax. So they mean it's a tax shelter. And depending on the period of time you look at, the value of a home has grown higher than the rate of inflation. And so they consider it an inflation hedge as well. Again, you still need a house to live in, whether your house is worth $1 million or $100,000. To me, it's six of one, half dozen of another. Few things to know about the costs of home ownership that your book talks about. Your down payment is usually, that's the first major issue. Most of the time, the traditional down payment was 20% of the price of the home. So $20,000 on every $100,000 that the home was worth. And in New York, the average here in Dutchess County, you got a $340,000 average home price. So you're going to need to scrape up a good 70 grand to put down that type of a down payment. Most people can't do that. So down payments usually are much lower than that. But nonetheless, 20% has been the traditional average. But you can buy a house as low these days without special programs, even as low as 3 to 5%. That will be enough to get you over the edge. Of course, you'll need a mortgage. You'll need a loan. A loan on a house is called a mortgage. And so the company or the bank that looks at providing you mortgages is looking at something called the loan to value ratio. Again, it's usually 80%. That's traditional. That's why your down payment was 20%. But in this case, the loan to value ratio simply means the amount of the loan you need compared to the value of the house that you're buying. The value of the house that you're buying is not necessarily what you paid for the house. They will send out someone to do an appraisal to see what the real objective value is. And that's the number they're going to use to calculate the loan to value ratio. Okay, you're going to need to know how to do that for this. What happens if you don't have a down payment that's at least 20%? Well, then the lender is going to require you to buy an insurance program to guarantee that they're going to get their money back. That's called private mortgage insurance. And anyone who gets a loan for larger than 80% of the loan to value is going to be paying private mortgage insurance, PMI. And that adds more money to your monthly payment. Okay, but the purpose of this private mortgage insurance is to make sure that in the worst case scenario, the lender will get their money back. When you get a loan, okay, you're going to be paying what we call points and closing costs. So points are basically fees that the bank charges you or the lender charges you to get the loan. Okay, it's just basically an upfront fee that they charge called points. So here is an example that if you borrowed $100,000 and they charge you 3 points, which is outrageous, you'd be paying a fee of $3,000 for that loan upfront. Some lenders don't charge any points. Oftentimes you can get lenders that charge you 1 point or 2 points. Now that's per 100,000. So if your loan was 200,000, it'd be twice as much. It'd be 6,000. Right. So points are based per $100,000 loan. Okay. So that's important to know. Before you can take ownership of property, you have to go through a procedure called closing. And closing basically is when all of that legal stuff gets dealt with and paid for. Okay. So you do have to pay for the loan. There's usually an application fee to apply for a loan. There are some origination fees, again, other fees for the loan. They have lots of fees. Here are your points listed here. You're going to have to pay mortgage insurance or homeowners insurance, depending on the size of the loan. Then you're going to need to make sure that the house can be yours legally. So there's a title search and title insurance to make sure that legally you can own the home. It'll be recorded as your home on the books of the government. Then you need attorneys' fees because they're involved because it's a legal process. So they're going to be involved to make sure it's okay. You have to pay for the appraisal fee to get the loan. Um, you usually get a home inspection. Matter of fact, it's your right to get a home inspection to make sure that what you're buying is structurally okay. If there's anything wrong with it, that'll be in the home inspection report. It's highly recommended that you do a home inspection. It's based on, it's for you as the buyer. It's something that benefits you personally because based on that home inspection, if there's a lot of work that needs to get done, or if they discover something structural, or maybe it's infested with rodents, then you have chances usually to negotiate on that or back out of the deal. So that's a very, very important thing. I would say it's worth the money. When you get a mortgage, you're going to be paying a tax on the loan, believe it or not. And then there's a bunch of things like filing fees and credit reports. So, based on the amount that you're putting down, in addition to that, you need to pay these closing costs at the time you take possession of the house. Okay. Um, in terms of the loan itself, the mortgage, this exhibit tells you that when you take a loan out, when you buy a house, when you start paying on that house, most of what you're paying up front is interest. So this blue line shows the amount going to interest. The red line is the amount going to pay back the loan. Assuming that in this example, you're paying over $6,400 a year, for that very first year of the $6,400, over almost 5,000 of that is going to pay interest on the loan. Only about less than 1,500 is actually going to paying back the loan. Okay. And as you see over time, as you pay more and more, and your balance becomes lower and lower, that's the mortgage loan itself becomes smaller, your interest payments drop over time, and the amount of money that you pay that's going to pay back the loan increases over time. Okay. So this is a traditional way that we amortize a mortgage or any loan you take, you're going to be paying a lot of interest up front, less as you go by, as the years go by. So here they have a table. Usually these tables are in $1,000 intervals, but it's a $10,000 table. There's going to be an example in the next page that show you a 6% loan for 30 years. So you're going to see this factor pop up again on the next page of your book. But this also shows you how to calculate using a financial calculator, how to calculate mortgage payments. When you're buying a home, you're not just paying for your mortgage. You're going to be paying insurance. It needs to be insured. You certainly don't want your house to burn down or something terrible to happen. And as a homeowner, you're going to be paying property taxes. Okay. And so property taxes are forever. Homeowners insurance is forever. So even when you don't have a loan, even when you pay your mortgage off, you're still paying these things. You will forever, as long as you own the property, you're going to need to pay those things. So just to know all of that, property taxes are the main way local governments um, fund their services. Okay, so property taxes is a local issue. It goes to your local town or city or wherever you live. Okay. And of course, never forget there's maintenance. You own something. If it breaks, if it needs any repairs, it's your problem. You got to fix it. Okay, you're the owner. You're going to fix it. So there's actually a lot to ownership that a lot of people overlook. It's good to know these things. Now, in terms of actually doing an analysis, the worksheet here is good to sort of understand. Here we have Rose and Elliot Turner. Um, they want to know how much of a house they could buy, knowing that they have a $75,000 yearly income. They have a down payment that's available as well. So this tells you basically you look at your annual income divided by 12. This is your monthly gross income. Now, this is the amount that the bank is going to use to calculate a few things. Okay. So first of all, they're going to say the most you can spend on your house on housing expenses is 28% of that. Okay. So the maximum mortgage payment, everything, based on that income is going to be 1755. So that's first of all how they do it. But this is for all housing. That's for all housing. Okay. Once you subtract out your property tax and homeowners insurance from that 1700, you only got 1380 left. So this is going to be the maximum amount of payment you can make on a mortgage. Okay. Now, if mortgages are at 6% and you want a 30-year mortgage, um, the factor for 6% at 30 years is that 5996 that I pointed to on the last page. So this is going to be numbers that they're going to use to calculate how much your payment's going to be. Now, assuming that their maximum loan is going to be based on their income, $10,000 times their maximum loan payment divided by the mortgage payment per 10,000 means that they have calculated 230,000 as the maximum home price they can afford. Okay, that's the most they can afford based on their income. They have $30,000 in a down payment. And paying closing costs. So they're going to need a little bit of dough. Funds available for making a down payment then is slightly lower than the 30,000 because they're going to need to pay all those closing costs. Which means when you add the 20,000 to the $230,000 maximum, they actually increase now their maximum home price to 250. And basically that's how they calculate. Now there, I have given you an example using an online calculator to do this. And I want you to pay attention to those spots. Those are very, very important. So you can tell how much of a house you or anyone else can afford based on their yearly and monthly income. Okay. This also shows you how to do it on a calculator as well. So important stuff to know and important stuff to learn. It'll help you in the long run.